The live market for Marvell Technology, MRVL, is currently closed, with the stock having finished the last trading session on September 5, 2025, at a closing price of 63.33, reflecting a decline of 1.2% for the day. This seemingly modest downturn, however, masks a much more profound and volatile narrative. The expectation for Marvell, a darling of the AI and data infrastructure boom, has been one of unyielding NVIDIA-like ascent. But the reality is a stock that has shed nearly half its value from its 52-week high, with the recent earnings report acting as a major catalyst for this dramatic repricing. Investors expected a continuation of the hyper-growth story, a script they've become so accustomed to in the semiconductor space. Instead, they received a reality check, a narrative of near-term lumpiness, and a guidance outlook that, while still strong, fell short of the loftiest analyst projections. This created a stark tension between the perceived invincibility of the AI infrastructure play and the gritty, unpredictable nature of a business that relies on a few, very large hyperscale customers. The market, in its knee-jerk, binary fashion, chose to punish the stock for not meeting an unwritten, almost mythological standard of perfection. The recent price action is a perfect illustration of this dynamic. The stock's significant drop was not due to an earnings miss. In fact, Marvell delivered record revenue of just over $2 billion, a staggering 58% year-over-year increase, and non-GAAP EPS that met analyst expectations. The numbers themselves were phenomenal, a testament to the company's operational strength. The drama unfolded not in the past, but in the future. Management's guidance for the next quarter, while projecting continued growth, came in slightly below the consensus. This single, seemingly small detail was enough to trigger a sell-off that saw the stock plunge 11–18% in after-hours trading and continue its descent in the following sessions. This sharp, violent reaction underscores just how sensitive the market is to any hint of a slowdown, no matter how small or temporary, in the high-flying AI sector. Trading volumes have surged in the wake of the report, indicating a massive reshuffling of positions. Institutional investors, including behemoths like Vanguard and BlackRock, hold substantial positions, but recent filings show some funds have been trimming their holdings, a sign of cautious reevaluation. Short interest in the stock remains a factor, with a negative volume balance on high-volume days suggesting a bearish sentiment is still pressuring the price, as sellers outweigh buyers on dips. This is a clear case of sell the news, even if the news is good. The narrative of endless linear growth was shattered, and the market is now grappling with the more nuanced reality of cyclical, albeit powerful, growth in a capital-intensive industry. The stock's current price is down from over 77 just before the earnings, a painful reminder of the market's unforgiving nature. Marvell Technology, at its core, is a semiconductor company that designs and develops integrated circuits for data infrastructure. It operates on a fabless model, meaning it focuses on the design and architecture of chips while outsourcing the actual manufacturing to third-party foundries, primarily Taiwan's Semiconductor Manufacturing Company, TSMC. This model allows the company to be nimble and focus on intellectual property and design. The company's business is segmented across several key markets, with a heavy and increasing emphasis on the data center sector. Marvell's portfolio includes a wide range of products that power the back-end infrastructure of the digital world: cloud computing, enterprise networking, 5G, and automotive applications. Its core business is built on providing high-performance chips for hyperscale data centers, which are the backbone of the AI and cloud revolution. This includes custom silicon solutions, which are chips tailored to the specific needs of its largest clients like Microsoft and Amazon, as well as a range of standard products for data processing, storage, and networking. The company has a history of strategic acquisitions to build out this portfolio, and a recent divestiture of its automotive Ethernet division for $2.5 billion has allowed it to double down on its data center and AI focus. This past performance and strategic direction is what initially fueled the high expectations for the stock, as investors saw it as a pure play on the most lucrative end of the semiconductor market. They looked at the massive growth in data center revenue, which now accounts for a staggering 74% of the total, and extrapolated a future of uninterrupted exponential growth. That's the core of the expectation that was just so dramatically challenged. Looking ahead, the future outlook for Marvell is a complex tapestry of both compelling opportunities and significant risks, all framed by that central tension between expectation and reality. On the opportunity side, the long-term demand for data infrastructure is undeniable. The continued proliferation of AI, cloud computing, and next-generation networks like 5G and 6G will require an immense amount of high-speed, high-performance semiconductor solutions. Marvell's strategic positioning in these areas, particularly with its custom silicon programs, provides a powerful long-term growth engine. The company's recent announcement about its new Structera product line, which cleared key interoperability tests with major memory and CPU providers, is a prime example of a catalyst that could drive future design wins and revenue. These new custom programs are expected to generate billions in lifetime revenue, but their lumpy and nonlinear rollout is the very thing that spooked the market in the short term. The long-term reality is that these major projects take time to ramp up, and their timing can be unpredictable. This is a fundamental characteristic of the business that clashes with the market's desire for smooth, quarterly perfect growth. Furthermore, analyst sentiment remains overwhelmingly bullish, with a significant majority of ratings being buy, and a median price target well above the current trading level, implying substantial upside. This suggests that while the market has reacted negatively in the short term, the professional consensus is that the long-term thesis remains intact. However, there are significant risks to consider. The stock's high volatility, with a weekly movement far exceeding the industry average, means it is susceptible to large swings on any news, good or bad. The concentration of revenue in a few hyperscale clients creates a customer concentration risk. Any slowdown in spending from a major customer, or their decision to insource more chip design, could have a material impact. The macroeconomic environment also looms large, as a broader slowdown could lead to a pullback in enterprise and data center spending. It's a high-stakes game where the rewards are immense, but the penalties for even minor missteps are swift and severe. This is the reality investors must confront. The central paradox of Marvell's current situation is this. The fundamentals of the business are incredibly strong, but the stock's performance has been anything but. The expectation was that a company with such a clear and dominant position in the hottest market in tech would be a one-way ticket to gains. The reality is that even the best companies are subject to the brutal volatility of market sentiment, and any deviation from a perfect growth narrative is met with a punishing sell-off. It's a crucial lesson that the market doesn't just trade on today's numbers, it trades on tomorrow's expectations, and when those expectations are built to unrealistic heights, the fall can be dramatic. The question for investors now is whether the market has overreacted to the near-term volatility, and if the stock is now a compelling buy-the-dip opportunity. The company's long-term strategic direction, its robust pipeline of AI-driven projects, and its dominant position in a high-growth sector all argue in favor of a strong future. But the path there is unlikely to be a smooth upward line. It will be characterized by the very lumpiness and unpredictability that recently scared the market. The final analysis boils down to whether you, as an investor, are buying the long-term thesis or trading on the short-term noise. Comment below with what you think is the biggest catalyst for Marvell's future growth. Is it custom silicon, 5G, or something else entirely? The contrast between the sensationalized headlines and the strong underlying business is a perfect example of why deep analysis is so critical. Marvell is not just another semiconductor stock. It is a high-stakes bet on the very architecture of the future, and its journey will be defined by the ongoing battle between reality and the often unrealistic expectations that surround it.